marry the house but date the rate thing.
Yeah,
This is a long-term relationship at this point.
They're saying 3 cuts this year, supposedly from the Fed, which will help us indirectly.
None of us like builders. Number one, I don't know if this is a RESPA violation or not, what they're doing, but I do feel like they're steering. A lot of them are opening up mortgage companies, as you guys probably already know.
I could be looking at it wrong, but it's like, it almost makes me feel like you're a renter in your own house that you own.
20% down is a good enough of a gap between 100 and 80 so you can absorb some sort of hit on value.
Two main business practices that are changing because of this NAR lawsuit.
I'm surprised a seller doesn't understand that they can negotiate a commission, because you negotiate everyone's commission on almost anything you do in life.
Arshawn, Ashari, and Chris Gonzalez. You guys probably know them from previous episodes. Welcome, guys. Thanks for coming on.
Thank you.
Good to be back.
I'm in the real estate and the real estate of mine.
Hello, everybody. Welcome back. So we're on episode number 16 now of the Real Estate or Mind podcast. This week, actually, it's the end of the quarter. It's the end of the first quarter of 2024. We're doing a wrap-up show. So we're going to be talking a lot to you guys about kind of the real estate market, the mortgage market, and kind of the general news, in the real estate industry. I got two guests with me. I call them my home team. Today we got two guys that, hold a special place in my heart. Arshawn, Ashari, and Chris Gonzalez. You guys probably know them from previous episodes. Welcome, guys. Thanks for coming on.
Thank you.
Good to be back.
Yeah, hell yeah. We got another show going, baby.
Yeah.
All right, so guys, for you guys and for the audience, I'm just letting you guys know what we're going to be talking about. We're going to do a quick market update. We're going to just talk about the market in general, kind of where interest rates are going, because that's kind of what everybody wants to know. Where are the interest rates going? How's the market? We'll talk a little bit about builder sentiment. We're going to go, and then we'll go into the Dream for All program. And we're going to end it with the NAR lawsuit, which is a huge topic that just went on. I believe it was last week they just settled. So we're going to talk, a lot about that. Well, anyway, let's get right into it. Let's talk about, let's talk about what's going on in the market. I do have, actually, me and Chris, we did a
forecast.
We did a bet. I don't know. It was a friendly bet. We did a friendly bet on where the rates would be, or what's the highest they would get. Recently, I don't know if you saw the news, but Fannie Mae has just announced pretty much their 2-year forecast. So from the beginning of 24 to the end of 25. So that 2 years, Fannie Mae is the only entity that is listed rates to stay at 6% or higher through the end of 2025. The MBA, the Mortgage Bankers Association, they have it coming into the 5s Q1. Wells Fargo has it coming into the 5s Q2 of 2025. But anyway, Mortgage Bankers Association and Wells Fargo are both in the 5s, while Fannie Mae's in the 6s, still up until 2025 Q4. What are your thoughts on that? What do you think rates are going to still actually? Do you think Fannie Mae is correct? Do you think rates are going to still be? They have it at 6.0, but 6.0 is going to be the average interest rate Q4 2025, which is basically a year and 9 months from now.
Wow. Okay.
So anyway, you guys want to start? What do you think about that?
I mean, yeah, I think that's.
Or where do you think rates are going?
I think 6% is a good spot, honestly, because we also can't have this inflation get out of control, continue to want to bring it down.
Yeah.
So what they're seeing is that the market can't go back down to 4% too quickly, if it even happens again, or 3% if that even happens, which I don't think so, but that's a different conversation. I think that forecast is good because if you think about it, they're saying 3 cuts this year, supposedly from the Fed, which will help us indirectly. But then you got if there's a new president, we have the elections in November.
Right.
Then the administration comes in when?
Q4
January
this year.
January 25, I think.
Usually that always reduces it.
January 25 is going to be the inauguration. But
but from November, yes, things start heating up.
From November, actually, from even October when things really start getting
ramping up,
or even September when politics really start hitting
front
pages.
Oh, absolutely.
Even if there probably are already.
It's just straight up 6 months. Just
strict
the
6
debates,
months.
and then we got the commercials and everything. But I think that's a good forecast. What do you think?
No, I think it's interesting. Is Fannie usually correct on these things, because the banks are seeming to go lower than Fannie, but who's actually got the true insider information on this? Who's more right? Does Fannie have a history of being more accurate than a bank like a Wells? Because obviously the banks want to, I feel be overly optimistic because it benefits them. It benefits it trickles down, benefits customers, benefits everything for them to have a more positive outlook than for them to say, oh no, it's going to continue to be higher. But Fannie might be playing it more realistic, which I agree with Chris. Like it causes stability, right? Like we don't want to see rates get low too fast. We kind of already had that problem, and I don't want to wake up one day and rates are just like going all the way down, because that would be kind of wild. I like stability in the market, and I think 6% is a really good range, and then start working your way back into the 5s. And then ideally, I think the market is best when it's like really around like 4.5. Kind of like when I first got in the industry and like met you. That's kind of where rates were, weren't they? They were around like 4.25 to 4.75.
Probably they
depending
were there
on qualification
for years and years.
Well, think about this.
Yeah,
Think
and
about
it was
this.
really good. The economy was really good.
Right now, rates are
transactions were good.
like roughly in the high 6s, early 7s.
Right.
Probably the average interest rate right now, I believe, is roughly 6.9%.
FHA 6%, 5.8.
Yeah, that's
with
the
a good
thing.
FICO.
FHA is still in the 6s. We got to get FHA like into the high 4s, and then conventionals into the mid 5s. That's
Huge
like
difference.
a great spot to be
Yeah.
in terms of refinances, purchases. Property values, like transactions, are really in that sweet spot.
Yeah. So anyway, when first rate cut. So I remember I was telling you I had Jason Twyford, the account executive, mortgage executive. He's saying May, and you were just telling me something before we started.
Yeah,
the
the
show.
market's pricing in. So there's something called
yeah.
the CME tool. CME is the Chicago Market Exchange. So they have for many years they kind of bet on it, like they have a probability tool, right? And when they're going to cut. Now it's never 100%, but they're usually pretty close, right? And right now it's May, 88% chance, 88.2% chance of a
That's
first
the first
cut.
one. And so
25 basis points.
I was going to say, if I understand correctly, I think each cut this year is expected to be 25 basis points.
It's a gradual.
I don't think they're going to do like a 50 or 75. That'd be way too
Unless
intense,
something
right?
happens in the economy and we
Right.
have issues, then yeah, obviously.
And these cuts are not built into our mortgage rates yet, which they usually are. I feel like.
I feel like
They price ahead. They price.
they're
Yeah,
priced
the
in,
market always
maybe.
prices ahead. So once
Yeah.
we get closer to May and they get word that okay, really is going down in May, then we'll see us start.
It's probably in April.
So late April, mid-April is going to be a good time. Yeah.
The rumors are really going to
Yeah.
tick up, I'm sure.
I think June. My thing is June. I mean, obviously, I could be wrong, but I think June is when they do the first cut. I think they'll hold steady. Then after the June FOMC meeting, I think they'll do the first cut, and then it's expected to do basically 3 cuts for the rest of the year. So basically, every other meeting you'd be doing a cut, right?
Correct.
You start in June, you get everyone hyped for the summer. Real estate's going to blow up in the summer, and then you basically do one cut right when the election talk starts picking up as well, and then towards the end of the year.
Yeah, a buddy of mine is friends with the CEO of SunWest, and he was saying that they're considering it like a little. You're lighting some tissue on fire, just a quick little flame, but then
Like Tinder.
real quick,
Yeah.
Tinder, and it's just quick, but it's not something that's going to start this refinance boom.
Right.
It's just something to get people going.
Something to
during
cool
summer.
down the market,
Yeah.
get people into buying. Because right now, I'm tired of people telling me, I'm going to wait for rates to come back down. Well, I mean, good luck.
Well, we're starting to see transactions. I'm sure if you look at the data, transactions definitely has to be picking up.
Yeah.
Especially in certain markets. It's getting hot. And
We're also coming into buying season, so that's also
that's the
gonna
thing.
help.
So
Yeah.
I'm actually glad rates didn't drop so much. The only people that are really banking on that are like the refi loan officers that are struggling, and they're like, oh, I'm going to take a leave of absence, or I'm going to find another career, and then I'll jump back in because rates will go from 7 to like 3.
Yeah.
That's how, you know what I mean? They're banking on that. But if you're a legitimate loan officer with business, you don't want that kind of volatility in the marketplace. It's way too much. Plus, everyone's refinancing your loans over and over and over again, and then it's like you're not even making money, and it's just nobody wants that.
Yeah, no.
So stability.
Well, it's being prevented also because the rates aren't low enough
Right.
to start churning, as we've called it in the industry. Right?
Which is great because
Yeah.
I tell people, hey, we're going to get you this beautiful house right now before the market heats up. You're getting a good value on the house. True, your rate is a little bit higher, but I'm going to call you at the end of the year, like literally around election time, holiday time. We're going to not only, your house has appreciated because of this like bull run we're going to start reaching to, but now I'm going to lower your interest rate. It's a win-win, and they're not calling a month later at the bank and getting sold on the new interest rate right away, trying to refinance loans so quickly.
So quickly. And
Yeah.
it also doesn't make sense to
Yeah, and they
refinance
lose money
too
on closing
much.
costs.
Yeah.
I don't even think a lot of borrowers even understand what it takes when
Yeah.
people keep getting these phishing emails and, hey, we can give you a lower rate right now. It's like, dude, they keep adding to your loan.
Yeah,
It's like
exactly.
you borrowed $800,000. Now by the time you're done, you're at like $840.
It has to make sense.
And yeah, your rate's lower, but it's a smoke screen. It's not actually benefiting
Well, you got to remember, people are only looking at their monthly payments.
Yeah.
That's like
Yeah.
the number one thing that they're looking, especially
Regardless
people,
of the balance
people who
growing.
are on some type of budget or salary
Yeah.
that they have to budget their money.
Right.
They're gonna be they're gonna be looking at monthly payment. Obviously, next thing would be the cost.
You know what is the good thing that came up recently? The appreciation right now. We're at zero
homes or
home appreciation right now.
Right.
Year over year. Actually, the last month it was 0.6%. So the reason that's a good thing is because now we're back to pre-pandemic reality.
We're getting 3 to 5% a year.
Yes, 3 to 5%. Not this 7, 8, 9, 10% appreciation that was not real during COVID.
Yeah.
Where people were bidding up homes. We all dealt with it. You know what I'm talking about.
Yeah.
The above asking price offers.
I mean, it was a seller's, like literally a seller's dream.
Oh, absolutely. Yeah.
Like, it's just unbelievable. Imagine your agents
but they're getting their money. I know they're bidding up properties, but they're coming in at value. And they're probably coming in at value because then you have like investors buying at cash. There's a comp in the neighborhood that sold.
That helps.
And there was no appraisal done. So he technically set the market with cash.
Well, that's exactly what it is. You can have one outlier house, right, that's going for beast value. You get that one appraiser to give it that value.
He has a comp because there's a...
True, but they can extend outside of any comp that they get as well. They can add and subtract, right?
They could, but I'm talking about if there is a legitimate comp.
Right, yeah. But imagine the guy that was setting tones in communities and gates, like in certain neighborhoods. This is like the guy that started it. Everyone's house is worth 2. This guy comes in at a 2.5. Now everyone's house is 2.5. Month later, the guy's like, you know what? I'm at 2.7. Think about how quickly you can go from like 2 to 3 based off of maybe 3 or 4 appraisals.
No.
3 or 4 appraisers just completely like...
No, but it's unhealthy too because a lot of our clients are also first-time home buyers. And it makes it difficult because now all of a sudden home prices are just keep getting out of control more and more, right?
It's too expensive. Their DTI is too high. They don't qualify. Maybe they went from conforming to high balance now. Completely, they don't have reserves or something. They're jumbo. Like it.
That goes into the affordability issue. We've talked about that. So we were blue in the face.
So it's good. I like the appreciation being steady.
Right.
If somebody's buying a home to bank cash out on it and bank and sell it in 6 months and make a boatload of money, that's not the move, especially a first-time home buyer. You want to fix your overhead. You want to fix your cost with a quick refinance later. Bring down your.
I mean, it's considered a long-term investment.
It's a long-term investment,
especially for a first-time home buyer. Unless you're like a flipper or developer, it's a get in, get out. But to be honest, it kind of reminds me of like the NFT bull run with what was happening with homes. People were buying. They're like, I'm going to make 30% in a year. That's like literally how NFTs were. And now
look what happened.
Now they're like basically long-term. Other alternative stores of asset is kind of like how I'm looking at it.
Right.
Somebody that keeps a project, you keep it for 20 years, and maybe it maintains its value over time, but it's not like, I'm going to get in at 10 grand. Hey, look, it's now worth 30 grand. Let me exit. And that's what kind of was happening with houses. It was very strange.
Yeah.
It's good. I like this appreciation.
So I like that that's going to stop. And also, I want to make sure people can afford these payments. Like a lot of us, even us, a lot of loan officers are doing the whole... what's it called? Marry the house, but date the rate thing. But you need to date the rate. So
they're saying it's a long date. They're saying it's a long date.
This is a long-term relationship at this point. So, again, when we're doing our pre-approvals, we want to make sure people can actually, like I said, date for a long time.
But the reality right now is this.
This might be one of your main girls for a while.
It is. No, but the reality is this. If somebody's buying right now, today, I'm talking this month, April, May, the likelihood of them refinancing in 6 months is extremely high.
It is.
Is extremely high.
Yeah.
But we said that last year.
No, yeah, right. But we didn't have the Fed signaling.
But there are people that did refinance. The guys that got the 8.875s or these really jacked up rates, or maybe at the time their FICO was
November 2023 is when we were like around.
Yeah, the worst time. That was
peaking.
the
because you also had that guy. Maybe he had his credit RAND score and it was 712. Went conventional, now to 760. He's already refinanced one. So there were people that did refi. Just depends on. The guys that bought down the rate, or especially imagine all those people that did the 2-1 buy downs or the 3-1. Those people are still going to be sitting until 2026, and then they'll refinance. Correct. So those people already priced it all in. They basically got it as a agent credit. But keep in mind, to get that credit, they basically gave up cash to do it too. You know what I mean? Because at the end of the day, they used agent credit to help them get a buy down, but you could also have taken that cash to cover their own closing costs. They almost spent their own money to do a buy down, if you think about it.
That is actually true.
You know what I mean? Think about that? Like, it's something I feel like people don't talk to their clients about because there's a lot of part of our business where you kind of just... you know what I mean? We have a transactional business where some things are almost on a need-to-know basis in a way, but at the end of the day, it's like, dude, you basically paid for your own buy-down because the agent agreed to a credit, and your closing costs were $23,000, and you could have just not paid that.
No, that's true.
You know what I mean? Like, so
that's a good point.
Yeah, you'd be better off actually paying your own stuff.
All right.
Yeah.
So I kind of let's finalize this topic. Where do we think the market is going in terms of rate? Just one quick. When's the first rate cut? Yeah, your forecast or
I'm gonna go
15 second, 30 second.
I'm gonna go with what the market's pricing in. I think May's the first rate cut. I think it's 25 basis points. So we'll feel it indirectly. We'll feel it really lightly on rates. Maybe like a quarter down on what good pricing is on a loan. That's what I think May. But we'll see that towards the end of April. But we're not going to see COVID decline in interest rates. That wasn't real.
Yeah.
So we're going to slowly start coming down slowly.
Yeah, no, that was a pandemic.
Yeah, I say I'm 1 month back. I say June because we realistically have the April meeting and the May. So we're already basically almost at the April one. We have one more meeting. They'll talk. Hopefully, Jerome Powell expresses some optimism. I think he'll hold one more time because he's really big on I need to see further data. I need to see this. I need to see that. I think it really kicks off the summer. That. I think it really kicks off the summer with the first rate cut, and I think the real estate market in summer really heats up. I think it's going to be really interesting for home buyers. Yeah. Yeah.
Nice. Appreciate that, guys. Now let's go. Next topic. I'm talk a little bit about builders. I'm going to read a little excerpt here about builder sentiment. I know, Chris, you talk a lot about home builder sentiment. So, home builder sentiment rose 3 points in March to 51 on the National Association of Home Builders Wells Fargo Housing Market Index. The reading gained for the fourth straight month, hitting its highest level since July. In other words, builders are getting more confident with the market. They're, starting to build more homes. And I'm getting a lot of more people that are in new construction, that are in escrow. Tell us a little bit, Chris. Tell us. I know you're big on this. Right. I don't think a lot of people know what that is. What is home builder sentiment?
It's technically it's almost a survey from home builders where they see the economy going because they have to. These companies are huge. So some of them are even Fortune 100 companies, and they have to hedge for if they believe rates are going to stay too high. They can't build, and they don't want to build too much because they're going to sit.
The future outlook is negative.
The future outlook. If the future outlook's negative, then they're going to be negative, right? Yeah. If they think it's positive, which is kind of coming full circle to what I was saying, they're going to feel positive. February's new home sales were down compared to what was expected in the market. And so somebody might be watching this thinking, oh, they're down. Look, they're contradicting. No, because February is when we had the rise in interest rates from this little inflation that we had at the beginning of the year, the January one. So they were down. It was 664,000 new home sales, and it was 667,000 expected. Right, which is not too far off. It's right there. Mm-hmm. It's right there. But it was because of the rates getting to the high sevens. Because we got to 7.5, high sevens.
It's funny that affects it that much.
Yeah, that much.
People look at, because you're talking about people looking at, I don't know, $80 a month, $70 a month. They're like,
give or take,
and they're like already backing away on new homes.
Well, also, isn't the thing with new homes when you buy it, it's like you're basically automatically buying something that's completely at the top of its market because you're not buying in a community where it's a steal or their comps are really good. You're buying with like-minded and similar properties at the peak because it's turnkey, brand new. So if a new home is $875,000. It's not going to just be $1 million all of a sudden, right?
New homes, you pay a premium.
You pay the premium. So I think that's also another deterrent as somebody that goes in a community and they're like, oh, look at all the comps are so aggressive with an extra bedroom. I have one less bedroom. My house is going to rise with everybody else. So I think that's another thing too, because it's a new build.
And another thing, I have a little bone to pick with the builders.
I feel like we all loan officers do, right?
Any loan officer who doesn't work for a builder, none of us like builders. Mm-hmm. The reason is because obviously they take our business. And I feel like, number one, I don't know if this is a RESPA violation or not, what they're doing, but I do feel like they're steering. A lot of them are opening up mortgage companies, as you guys probably already know, and they're basically backdooring the money. So if you guys are buying a new home, you are going to be, let's just say, I'm going to use the word forced, because that's what you make clients, even though you're coerced. Even though you're not forcing them, it's the feeling that they get inside of their, of their hearts and of their that they have to go with this lender. And they are also giving a credit. And these are like $15,000 credits. Yeah. When I'm buying a house, they're also baked into the interest rate.
That's the thing. Rates are always high.
I'm giving you a 6.8. They're giving you a 7.25, and they're charging you. But they're giving you a $15,000 credit, which is going to make up for $15,000 is a lot of money on a $600,000, $700,000
for closing costs.
But that's the difference in the spread between the rate.
And I can't make up for that. Yeah, exactly.
That's the difference. It's a half a point on that spread of that big of a loan amount. You can get to $15,000. Like if you want to buy it down, it's going to cost $15,000 to go from
2.5 points.
50 basis points will cost you $15,000.
Roughly, yeah. And I don't know. Because I'm not gonna say I'm losing a lot of business, but I'm just running into it where they want a new home, and I already give them the disclaimer up front. Hey guys, you're gonna go into the builder's office. They're going to make you talk to their lending finance partner.
In-house or whatever.
And you are gonna
Eagle Home Loans.
Yeah, they're actually out of business.
Are they?
They changed the name of the. They changed the name
Oh
of the
wow. Okay.
company. They're under.
Was that Lennar?
What's Lennar?
Yeah.
Lennar now has their own mortgage company. I think it's called literally Lennar Mortgage or something.
Wow.
But yeah, because I bought a Lennar home and they made me do it.
You bought a Lennar home? Which house?
I bought a Lennar home in Anaheim in 2000.
Oh, that one? Oh,
straight
wow.
up from the builder. Obviously, they made me talk to the builder.
You went to the builder yourself, even though you were a loan officer at the time?
It was the only one. I was getting a good deal. It was the only one left. They discounted it to kind of get rid of it. It was like the former office of the community.
Oh, wow.
So like they discounted it. But anyway, I'm bringing this up because it bothers me, and I wanted to see kind of your opinions and if it bothers you, because I have lost a few deals.
Yeah.
I just lost a deal to one of the worst banks out there, Wells Fargo, giving a worse deal. But because of the credit, they were giving the credit, and I couldn't make up for it. I was giving them a better rate, but it's not enough.
Wait, what if you matched their rate?
I think they were doing with the credit. They were doing the 2-1 buy down.
Oh my
but
gosh.
they weren't going to give me the credit, so it like screwed. It's done.
See, that's what
it's
I'm saying.
Over.
Yeah, they only give the credit to whoever
And obviously,
they work with.
Yeah, and whoever they work with. And I don't know
Yeah.
what these companies are doing. I mean, you builders that you're listening, how much money are you guys? How much money are you lenders giving these builders? Because I know this isn't.
Oh, backdoor. Yeah.
This is
yeah.
a pay for play.
Yeah,
This
yeah.
is not. There's too much money involved for you guys to be steering your clients into these lending partners.
Well, do you think some of these builders, their in-house mortgage companies, take losses to make sure that they keep the numbers? Does it look better for their data to say, hey, we actually
Absolutely
financed
not.
this whole building,
No.
maybe 10% of it
There's
was
no
at...
company that's going to lose.
Not like lose, but like you almost go zero margin, just like getting a massive price.
But they're not giving that great of deals to go zero margin.
But the credit eats up all
The credit's
difference.
coming from the builder. You know, these builders have
Yeah.
massive margins,
Right.
and they're making a
Yeah.
ton of money.
Okay, so they have like almost like a bank account that's just
Yeah.
with
and,
funds.
and
that
I
they
don't.
can
I
just
don't see
credit
why
out
I
of,
can't get that
essentially.
credit. Especially, I get a lot of builder turn down. So, builders, call me for your builder turn down.
Yeah.
But any turn down business, like I have a builder right now. She's already sent me a couple deals. She might have another one for me. They're not giving a credit, so I won't get it. Neither will my client. But I'm getting their turn down business.
Well, see, let me stop you right there. This is the funny thing. We're coming in as backup, and we're helping the client save the loan,
Yeah.
get their house, save the escrow, right?
Get them the house.
Get them the house, and they're
Yeah.
happy.
get
Everybody's
them a
happy.
good deal and all that kind of stuff.
And if this builder is getting the house off the books and getting it sold
Yeah.
to help their books, isn't that something they should be appreciative, like in
Yeah.
reference to seller credit, like credit?
Yeah, but you haven't paid for my marketing. You haven't paid
That's
for
what they
this.
do,
You
I
haven't
know.
paid
Yeah,
for
I think-
that.
I think at the end
they're
of the day-
basically giving it back. They're giving it back to the client, though, so that it is technically like.
I think at the end of the day, a
way to
builder
do it.
wants to help internally finance every single unit, and the ones they probably don't really care for are the ones that are the turn downs, and they're like, okay, they're
tough
probably
ones, yeah.
comfortable with that. They're like, okay, out of our entire unit, 10% are turn downs. You guys can go get your other loan officers to help us get the unit off the book, but I feel like every builder, obviously, you'd want to finance every single unit yourselves
Yeah,
and
but
get all A paper
Yeah,
clients.
but I want the credit. That's my question.
So
Why
you want the credit from the builder for
They're,
the
they're
10 grand.
already giving it away.
Well, I mean, they're in
to a
cahoots
third
with their
party.
own lender, right? So it makes
Exactly.
sense. They're
Yeah.
going to be like, hey.
That's the problem. I don't know.
Yeah.
I'm not sure if it's illegal. It's probably. It's. I assume it's legal.
Honestly, it's just basically something that hasn't been talked about or a
No, I
loophole,
feel like it
if you will.
has to be legal because
It's
they're
le- it is
financing
legal.
their own
Yeah.
credit.
It is.
So
it
why
is
would that be legal,
No,
right?
It's 100% legal.
Yeah.
What they're doing, but is it legal to steer? And you're almost steering because you're like, you could even do this when you're selling a house. It's the same idea. It just looks worse when you're selling a house because you only have one. Well, I'm selling my house.
Yeah.
You have to use Arshawn as my loan officer, and I need you to use him. If you use him, I'll give you a $10,000 credit from me, the seller.
Right.
Yeah.
If you don't use him, I won't give you the credit. It looks way worse when it's a seller.
Is that
That's what they're
legal?
doing.
Is that legal though? That's actually
That's
actually pretty cool. I want to start seeing how I can
I think
implement it. Almost like
that's-
it's like a double end, but because you have this bonus kicker,
Yeah, but
it's
why?
a
But why
strong
would? But why would the
crossball.
seller? Why would me, the seller? Why would I give only if they use Arshawn? Obviously, Arshawn. There's some
Because
financial
yeah,
There's
benefit.
a
Absolutely.
relationship
Yeah,
there.
yeah.
There's a
I mean, that's how
relationship.
everything is in business. It's always
No,
you
I know it's a bit. Yeah,
It's almost
exactly.
like a sponsorship too.
It's
Yeah.
something like that. It's
Yeah.
got to be some type of sponsorship or.
But you'd have to find a way to make it legit where it doesn't look like a kickback situation. Where like as a loan
Well, it's not a
officer,
kickback.
if I
I'm
go up,
giving the client money. I'm not giving the loan officer money. I'm not giving.
no, but you're saying as the seller, right? You're giving the client
As the
money.
seller,
but
I will
for me
give
to
a-
have that agreement with the
But you
seller,
have to
am
use-
I not going to the seller and saying, "Hey, Here's
you're the lender.
I'm basically funneling money through the seller back down to the client, essentially, or I can go directly to the client, right? Like I give the credit as a lender, essentially. Work with me. Tell everyone to work with me. I'll give them 10,000 as that's the legal way. Obviously, if I was doing it through the seller, that's like a kickback kind of thing.
I mean, technically, they're both legal. I'm just worried about the steering part. Like, where, like you use this guy.
Is that considered steering though?
I don't know. I'm not an attorney.
Well, it sounds like steering.
It
sounds
is.
like,
I think it's. We can think of it as steering.
Wait, but it's okay. I don't know. What's the fine line between like here's a suggestion and here's a perk and a bonus that comes with that suggestion versus like you have to do this?
No, you don't have to use him, but I'll give you $15,000 if you do.
But they're gonna make it look so enticing.
That kind of sounds like steering, but also sounds like, hey, you could use him. You don't have to use him, like you
no,
said.
You don't have to use
him. But if you do, he's willing to give you $15,000. I can't say what the other guy's willing to do. I don't know. I could just have, like it's kind of
everybody's bending over for the other. It's just a little too much because it's the builders on your side, and you really want this builder's home because it's brand new. You know, it's premium. Everything's new. This is the house I wanted. Blah blah blah.
What if
people
Yanni,
fall in love with the house?
What if your angle to all the builders were if anyone does a new home purchase with the builder through fast action mortgage, like I'm speaking like as you, Andrew, everyone that does a loan with me gets $10,000 in closing cost credit.
I can't give that kind. We don't make that kind of money.
Rebate.
We don't make enough. We don't make enough money for
that.
What if you could, because all you did was basically just give them a rate that came with a $10,000 credit?
What's the point of giving people? I don't give high
volume.
Rate.
You get everyone's.
Yeah, but I don't want to give somebody a high rate. It's the same idea.
Well, not a high rate. The builder, I've never seen a builder's quote that had a really phenomenal rate. The builders don't give good rates.
No.
I've worked against Pulte Mortgage, these kind of companies, their rates are bad. Even on FHA, because obviously you can get a lot of them get FHA.
Well, we have some of the better
the rate was
rates,
like 7.375.
Yeah.
They called me saying they're being mistreated. I think I told you the whole story.
But they're also retail.
They're being mistreated. I'm like, this rate is absurd. I was at like a 6.375, almost like 1% lower. And then, sure, they were giving $10,000, but I'm like, I'm almost 1% lower. You know what I mean? I could probably give you some credit, and it's actually a better deal. So, I wonder if there's a way to just completely like take all the builder business by guaranteeing $10,000 credit for everybody.
No,
I think it's too hard. It goes back to
not that way. It has to come from the builders.
It goes back to the friend that I told you will be unnamed, the VP of that builder that I know, family friend, and she told me that they pay the marketing for the whoever it is. So they use Wells Fargo, and she says they throw thousands of dollars at their marketing. So it's a you scratch my back, I scratch yours type of situation.
And every business and every industry is like
that's what it is.
It's a symbiotic relationship where they're just living off of each other.
Correct.
You know what I mean?
Absolutely.
Yeah. Exactly. That's basically it. Well, anyway.
To be honest, I personally don't deal with a lot of builders. I think, of course, obviously, it's certain areas where you buy and where you don't buy and stuff, and certain markets where they're building. But I'm assuming the hottest market right now for a builder would have to be building SFRs, right? Because isn't there data showing that like there's like no SFRs left because all these massive institutional people like BlackRock, State Street, Zillow, they bought all these single families, and now everyone's
just getting... Well, as a builder, you want to build like the townhome style.
Right.
Because you're building like 4 on 1
Because you can build, that's the problem.
And it's way more.
There's like not enough single families.
Like here in our area, it's all the townhome.
The more profitable for them.
The 3-story townhome
for sure,
style.
You stack them, tier them, you put 4 on top of each other.
Easy.
Well, no, it's one home. They're not on top of each other, but you just can fit more into one part.
Yeah, he means condensed, like
Oh yeah.
But builders aren't also doing like units? They don't do like apartments like that too?
I'm talking about
like you can own
those
the condos.
Are like condos.
Yeah.
I'm talking about
because those probably make the most.
Like I'm talking about single family home or what they want you to
what
think.
They want you to think
is
what
a
they
single
consider.
family
like
home.
SFAs, like straight up like attached side by side, basically townhouses.
Like we have some across the street from our office now that are. I don't know. We don't know if they're gonna be attached or not because they're not done yet.
Actually, this is a random question, but what actually truly separates what's considered a townhouse versus an SFA? Is it the way title or the zoning?
Single family attached.
Yeah, because next to where my parents live, there's like there's like single family attached, and I'm like, it's just a townhouse because you're sharing your common wall.
Well, no, a townhome is so that's what people get confused. A townhome is a style of, it's a condo. Where it's a style of home.
It's like you don't have anyone above or below you ever really on a townhouse.
Usually,
it's
a
it's 2
townhome
stories,
would have
like,
it has a garage.
Sure.
It's basically more of it's a single family style home and usually has stairs.
Right.
And it has like a little backyard. It's townhouse style. So
right.
So it's not apartment style. You have an apartment style condo or you have a townhome style condo.
Right. So the difference between that and an actual single family attached, is it just based off of how like it's how zoning and title is?
That would be the title. That would be.
That's just all it is.
Townhome
really.
is a style of home.
Yeah.
Single family attached is way that a builder would take title.
Right. Okay.
It's not a style of home.
But visually, they're like the same. Like I've been in single family attached and townhouses
Single-family
that are both
attached
two
will be-
stories.
yeah.
They maybe have a foyer. Like, you know what I mean? It's like they look the same, but
They would look the
But they're
same.
like, this is worth way more. Why? Because it's technically single family attached. I'm like, but it's like a condo. Like
Looks
you're literally
similar.
buying a condo. The
I
whole
know,
point
but
of
you
single
just-
family to
yeah.
me is like I don't want my wall to be literally touching my neighbor's wall where I can hear them having breakfast.
Well, you
in
know
my
the financing
house.
is different on single family attached
Right,
versus
and the financing is- yeah,
condo.
right.
It's a tiny bit different. You know about
Exactly. So you'd rather have the single family attached, but I always wonder. I'm like, you're pretty much buying like a
Which is
condo.
basically also a PUD. Which
Yeah.
I don't know if we want to get on.
No,
Anyway,
yeah.
I want to. Yeah. Anyway, so that was good. I wanted to talk about those builders, man,
No builders.
because
Yeah.
they're killing me. They're killing me with. We actually, they're just coming.
Do every builders offer credit? Like all of
They
them or
don't
not?
all offer credit,
Okay.
but
I haven't come across one that doesn't offer credit, honestly.
They
I have
usually
one
do.
now
They usually do,
specifically
yeah.
that I'm working with that is not offering any.
Might be a
credit.
smaller builder.
It's a small builder, but you're talking about 30 homes, 20, 25 maybe.
Okay.
Anyway, well, thanks for all that builder stuff. I just had to get that off my chest. The next thing the next topic I wanted to discuss was, the big news in the down payment assistance world. I know some of you guys, it's your favorite loan. It's your favorite loan product.
The dream for all.
So the Dream for All program, for all of you guys who don't know, it's the California's Shared Appreciation Program, where California is giving 20% up to $150,000 of the value of your house in order for you to purchase a home. Obviously, they own 20% of your house.
But up to 20%. So you have the option of borrowing 5 or 10%. It's up to 20.
It's
So
Well, yeah,
if you don't need the money, you can honestly
no,
just
it's
borrow
up to
10%.
150. You got to take the money, I think.
No, it's up to 20. I'm pretty sure it's up to 20%.
I don't know the details, but you're probably
Why
going to.
would you do 5%?
I don't know why.
Because the less you borrow, let's say you need a little bit to get you over the edge, the less you owe them back. So you can actually only take 10% from California, and then you
I
only
don't
owe them
know.
back 10%.
I don't
You get
think-
10% appreciation.
They haven't put that in the
Before
guidelines.
this recent revision, that's how it was because I really delved into the rules.
Last
and it
year?
said the one that was exactly
Yeah,
the
yeah.
last round where they ran out in like 5
Yeah,
minutes
yeah.
because they opened it up to basically investors at this
Yeah.
point. Like people were just milking it. That was up to 20%. Now maybe it's different. I'm not as versed on the change. I just know that you have to be a first time like generation buyer.
Yeah, so I'll talk.
which
I'm gonna
is
talk.
like-
I'm gonna
yeah.
talk a little bit about like
Sure.
the program guidelines for those people that are listening. So this year it's going to be roughly 2,100 people, just like last year, who are going to get into the program. Applications are open April 3rd on the CalHFA, the CalHFA website, to apply for your Dream for All. Your house. It's basically a housing voucher. You'll have, like I said, up until April 29th. Then there's going to be a lottery. And you just said one of the main things is if you're the only person on the loan, you have to be a first generation buyer, meaning your parents don't own a home. If you're like a husband and wife, either the husband or the wife has to be a first generation. The other one also has to be a first time. So even if his parents own a house, let's just say if the husband's parents own a house, this needs to be his first home.
Yeah.
And first home means you haven't owned a home in 3 years, so it's not a real.
Right, not ever.
It's not ever. It's in the last
They
three
really made
three
it
years.
a niche product this time around. They cut off like
They had to.
85% of the demographics.
You know how crazy it was last year, right when it came out? Like a week later,
But I
the funds
think
ran
having
out.
to be a first generation, that is extreme to me. I think they should have just made it more strict in other ways to qualify, or maybe you have to meet certain ranges
FICO?
of income or certain age ranges.
There's a
right?
problem
Because it's
with
supposed
that,
to be
though.
for first-time home buyers, so like it should be like certain ages. Find other ways to minimize the filters, but the first generation one, it's like
I don't know how they're gonna. That's the thing.
tough.
Yeah, how are they going to find
It's
out?
gonna.
Don't we
most,
all know
most likely
everyone
it's
that
gonna be a
somebody owns a
question
house? Yeah.
on your application. The applications aren't even released yet, so I haven't even seen what they look like.
Oh, really?
But
Not released yet?
I went
Oh,
to
I
the
thought people were already throwing people
website
in this
actually
program.
before this podcast, and they're not up yet, so I can't even see what they look like. We obviously are a CalHFA approved broker lender, so we can do these programs. But yeah, anyway, what I was going to say about the housing voucher in terms of the first generation buyer, I assume it's going to be on the application as a question. You have to. There has to be some kind of honesty in this. Like, there's no way I can prove that, like, my parents didn't own a home in the last 3 years.
That's the thing. How do they prove that? Is there
And
any
so
data on that whatsoever? Any kind of like metric?
Because any
What
person.
about the underwriter associated addresses? You think they could?
That's
look
the
it up?
only way they're going to do
Yeah,
it, right?
but
They're
like a
gonna look
lot
at
of people,
everything,
sometimes maybe they don't have the same name as their parents, or maybe like
Yeah,
that, or
that's
maybe
true.
that's my uncle. It's not.
Yeah.
It's not. and is my uncle a first generation? Like, do they mean only parents, or do you mean like anybody in my extended family?
Like, well,
no, it's immediate family.
But it's immediate
like your
aunt or
parents.
uncle.
Like,
or
what about
no, parents and grandparents.
Just grandparents.
Is grandparents part of generation? Right.
Well, yeah.
That's it. It's just it's
No,
not uncle and
but
stuff.
what
That's,
I'm saying
that's
is,
different.
it's,
That's relative.
now you're diving deep. How
Yeah.
far is it gonna? Because I'm sure somebody's owned a home. These homes in 1945 were like $3,000.
Yeah.
I'm sure somebody owned one.
Or like you said, the different last name, dude. They must do like full. Like obviously, if you do a background check on me, you'll see like my parents' name. It shows up. My mom always shows up on a lot of stuff.
That's because you have a unique name.
Right. Yeah. So
And
I'm sure they do what they can, or fraud guard or whatever.
Right,
They'll do all the background checks. They'll do the credit reports.
If you have a
for
really
associated
common last
addresses.
name, one of the common like the Latino names, or
Yeah,
even like
yeah.
a Smith, the Williams, the Johnsons, the Garcias, the Gonzalezes. The,
Yeah.
Bro, how many do we have out
yeah.
here? Like, how are you gonna know that's my dad? Like, or that's my mom? Like, you're. Not,
I think you could get around the common last name. Yeah.
You're gonna
There
be
is
able
a
to
way
get
to
around
cheat the
that.
system on that. There has to be. Just naturally, there'll be people.
Anyway,
that take advantage
I know,
of it.
like some people I've talked to, they're not huge fans of the program.
Yeah.
So.
You want our opinions?
So we could let's talk. Yeah, so this program, let's
Yeah.
just
No, so
break
so
it down. I know.
The thing is,
go ahead.
it's not that I'm not a big fan. I just have so many different questions that I feel like no one can really answer. And I've even gone on like YouTube. I've watched other people who have like social media or do podcasts about it. And it's like what I want to know is what happens if the house goes down in value? What happens if I need to do a short sale? What happens if I bit off more than I can chew because I got financial assistance, which it's financial aid. I basically got help
It is
buying
financial
something,
aid.
and I can't even make the payments anymore. What if I don't have a cosigner? Because it does allow you to have like a cosigner with those rules.
Are you trying to say you're going to go into foreclosure?
No, it's like, dude, I need to short sale foreclosure. I can't make my payments.
sale
What if the
is-
market goes
sure.
down? What if rates jump up to 10%? And I bought my house for $800,000 because they helped me with
Sure.
20%.
Let's go one at a time.
Now it's
One
worth
at a time.
$712,000.
What's your first scenario?
No, but I'm just saying, like, have they talked about any of those hypotheticals?
First of all, so let's just go one at a time.
Yeah.
Short sale, right?
Okay.
So a short sale is done through the bank that lent you the
Right.
So there's a bank that lent you 80%.
Right.
They have to take a loss.
Right.
The second mortgage lien holder, they might have to take a loss too, which is CalHFA.
California has taken that loss.
California,
So you're saying,
California.
We're talking
You're
hypotheticals.
talking hypotheticals.
Right.
They obviously would have to take a loss.
Yeah.
If you're selling the house and the first lien holder has already agreed to it, they're probably going to take a loss. They're not going to. How much? We're in California.
Yeah.
Home prices are going up. I don't know.
No.
how
So
much
okay.
of a
So
loss
that's
they're
just
really
one.
gonna take.
That's just one
Hold on, real
hypothetical.
quick.
So basically,
Before you
also,
move
like,
on,
yeah.
let me go back to this. If you look at Dodd-Frank was the after the 2008 crash, was what regulated our. I'm saying it for everybody else. It regulated.
Obama implemented
it regulated our industry. So we went to credit scores. We went to debt to income ratios where
Right.
they started existing, and so on and so forth. Also, 20% down. Okay, 20% down is a good enough of a gap between 100 and 80, so you can absorb some sort of hit on value.
You're saying it's like a type of a hedge.
It's a hedge.
Okay.
That's why 20% down became quote unquote the norm, even though we have 3.5, even though we have 5%, even though we have as low as 3% down.
Yeah, they make you get the insurance on
to
it.
make
pay
you,
the
yeah, but
insurance.
that's
Yeah.
right. Those are really like tougher deals.
Yeah.
But my point is, the 20% down is enough of a hedge that if values come down, because even during the recession, if you would have put 20% down in 2008, you might be closer to 100, but you wouldn't have been completely underwater.
Yeah.
The reason those people were underwater is because their loans were negatively amortized.
Right.
So all
And
of a
they're
sudden,
ballooning and
they're
stuff, too.
ballooning. All
Yeah,
of a
yeah,
sudden,
yeah.
they're like, wait a minute,
Yeah.
that's different.
The
That's
option arms and stuff.
yeah, that's
I
different. That's
remember seeing
different.
those, yeah.
Now 20% is good enough of a hedge, so they're taking a risk, and it's a bigger reward for the state of California. Honestly, it's a bigger reward for the state. Of
I think for the
California.
state of California, it's a huge win. They're sharing depreciation in a ton of homes in a state that constantly goes up. It's one of the biggest economies alone, like in the world, literally, is California by itself. So it's not like this is happening in like a Midwest state where properties are stagnant for decades. But I understand it's a win-win for California. But that's just one situation. What if?
Yeah. What's the next
What
scenario?
was the other situation I was talking about? What if
Foreclosure would mean.
What if just home
like,
prices in general goes down? So not foreclose. Like let's say I don't need to do a short sale or anything. What if my house goes down? What if I want to refinance and my house is going down?
Let's divorce. Let's say that.
Is
What
my
somebody-
LTV not over 100%?
What happens if somebody's getting divorced, and they bought Dream for All?
Yeah.
But you're assuming that they're divorcing quickly after the purchase.
Right.
Or,
well, what does it matter? What if it's a year later? The house probably can go nowhere.
Two years later and house prices tanked in that area. But it's the same situation. It's the short sale situation you just talked about where you don't have enough value. Same thing. Somebody's going to be taking a loss.
Yeah.
But at the end of the day, you came in with no money. You are my home buyer. You still came in with no money. You're going to have to take, and the loss you're taking now, the bank's taking that loss. You're not taking any loss. You had a house, and you should have been making those payments. You should have built up some equity. But anyway, long story short, the bank's going to take the loss. I mean, the banks.
Yeah, I mean, but
they're going to have to agree to it. It's going to take a while. It's going to be a process, and you got to remember, you're one out of 2,100 people who got this loan. So, like, how many people? And the payments are affordable, like he just talked about. They're hedging.
20%.
I just helped you put 20. I'm in the state.
No, but here's the thing: the guy that calls me and says, "Hey, I have no money down. California's going to give you my 20%, and I have no MI." He's now getting a monthly payment that's completely unreasonable, maybe for him if he's a W-2. It's different if you're self-employed.
What do you mean it's unreasonable?
Like the guy probably is renting for $8,000.
You still have to qualify. That's an income.
Yeah, but a lot of the qualification is because we just boosted him by 20%.
Well, he's not making the payment on the other 20. He's only making the payment on 80. Is a loan of 80% plus taxes and insurance. It's like somebody's giving you 20%.
But just like all down payment assistance programs or like the VOEs and stuff that we do, it does overextend someone's qualification to get them to qualify. It's qualifying you for something that you wouldn't have otherwise qualified without the down payment, right?
I know, but you will never make a payment on the assistance ever. There's no actual monthly payment on it.
Yeah, but I'm buying now something more expensive in the area that I want to live in because I'm able to get the 20%.
You're under 45
But you
DTI.
qualify. That could happen to somebody who doesn't get down payment assistance.
Yeah.
The same thing. They lose their tech job, and all of a sudden the guy went from making whatever to like being unemployed. Yeah, that could happen to anybody. I mean,
no, I know, and that's why I do think.
I don't see your point actually.
No, I think that's why I think with down payment assistance, it can be risky because a borrower is basically getting a monthly payment that originally they wouldn't have qualified if they were not getting a down payment assistance.
But that's not true.
Why not?
It's not
just
true.
Because the DTI qualifies at 50%.
It's not because what they're giving them is the down payment to pay down the loan that much.
Basically, long story short, like you qualify for a $4,000 monthly payment, right? Because that's what you qualify with or without assistance. The difference is with the Dream for All, now I'm buying an $800,000 house. Before I was buying I'm buying $800 now. I was buying $600 before. So now I get a nicer home for $4,000 a month. That's just the difference. The same thing, the down payment assistance. I don't like a lot of the down payment assistance programs because let's just say I was buying a $500,000 house. Now I'm getting assistance. I'm buying a $400,000 house because now I have a second lien on the house that I'm paying on possibly, but my payment is still the same. I could still only afford X amount, but now I added a second lien and they added a higher interest rate for for a standard down payment assistance. They have higher interest rates. These interest rates are actually not that bad. Yeah, at least last year they were pretty competitive.
Yeah, they were right there.
They haven't been released this year, the interest rates for the Dream for All.
Yeah.
But they were pretty competitive.
Yeah, because typically down payment assistance is like what, 0.5% higher, give or take?
Man, we're giving high sevens on FHA, but sometimes you're getting a grant and then.
Well, they don't have the zip and stuff too on there too. That covers
they have stuff, but
the forgivable zip or something.
But point being is your monthly payment doesn't change. It's just the price of the home changes because you're getting assistance. So now, like I said, you went from a $500,000.
Well, doesn't the price of the home also directly affect your property taxes rate, your home insurance rate, and your HOA rate? Because now maybe you go buy it. So
correct.
You know what I mean?
But you went down in value of home because you got assistance. Like if you gave a down payment, now you could buy $500. If you're not giving a down payment, you're buying $400.
Yeah.
So
the 20% that they lend you, what's the actual payback rules on that aside from if you go to sell the house, you owe them back? Like, is there an X amount of years before they make you pay that back to them?
30 years.
30 years?
30 years or when the first lien is paid off.
When the first lien is paid off. So in the first rendition of this,
you can't
they allowed you to refinance once.
Correct. I'm
What's
sorry.
The rule
I apologize. I take that back. Yeah. I got to read up on it. I don't want to misquote anybody. I think you can refinance.
I don't think they changed the refinance. I think
so you can do one refinance where they'll almost subordinate
correct.
To get you a lower rate. The next time you want to refinance, you basically have to pay that.
You have to pay the...
And then you said in a case of a divorce is another situation, right? Because now you have to there might be a.
It's the same thing.
What is it? What do they call it? Do they call a loan due?
Well, there's only two things you do in a divorce: you refinance the other person off, or you sell the house. I mean,
so you're gonna refinance. Yeah,
really,
I'm almost sure it's gonna be the same as
only two
last year. Like
options
you
you
said,
can do,
like you're probably able to refinance once.
I mean, I don't know. Maybe I could be looking at it wrong, but it's like it almost makes me feel like you're a renter in your own house that you own. You're almost renting your own house.
No.
They've lent you had no money. They're giving you 20% to put you in a house.
No, I know
They're
what it
also
is.
taking your appreciation.
It's
So when you go to
about
sell,
that.
you're
But look
going
at
to
it
get
this way.
100% of the growth. It's like just buy a house that's
But look
within
at it
your
this
means
way.
and take all the appreciation.
I know what you're saying.
California, it's
I
a
get what
win-win
you're
for
saying.
California.
But
It's not a
like,
win for the borrower.
but
It's
you-
definitely not a win for the buyer, in my opinion. I don't care how you spin it. It's not
So
a win.
basically,
You'll
if
get
you-
screwed later
If
down
you're
the
familiar
line.
with partnerships, this is basically a partnership. They are a limited partner in your home. So you are the general partner. They are the limited partner, meaning the general partner controls everything. The limited partner is basically just an entity that gives you an investment. So like I'm giving you 20%. Like you're gonna go buy a fourplex or you're gonna buy some multi-unit property, and I'm gonna give you 20%. But I'm tenants in common with you. I want 20% of that house. It's the same idea. You don't owe me any money, but I'm a limited partner in your house, so I want 20% of the profits.
Yeah.
The first
That's
time I
all
heard
it
about
is.
the first time I heard about this wasn't the dream. Remember, I had that client in 2021, a refinance that I had at U.S. Bank, Sarah Adams. Remember, and so she got 20% down as the same shared appreciation before this was part of like the state thing.
Oh, yeah.
And I asked her too, like, don't you feel, because I saw the appreciation. She bought in Irvine like 8-9 years ago for obviously way cheaper, and her house now was worth.
Millions,
Almost like 2 actually million.
Yeah.
And I asked her like, don't you feel bad? Yeah, but she told me I wouldn't have gotten the house without.
It's an infinite
the
return.
insistence.
You came in with
Yeah.
nothing.
Yeah.
So that's what I'm saying. So like as an investor, I always look at when I'm buying my properties, I'm looking at cash on cash return. Like I spent $10,000 to get $100 a month. This one I spent zero to get whatever I'm getting back. I spent zero.
At
Zip.
the end of the day,
And I'm
you're
gonna
gonna
get
have
money
to,
back.
You're gonna have to.
You are paying your
pay
payments,
the
though,
piper
obviously,
one
yeah.
day in the future.
Yeah,
So
they're
have
gonna
to,
get
like,
they get back 100% of their principal that they lent you, no matter what.
The 20%.
And
Plus
then,
the 20% of whatever comes
and then
back.
plus 20% of whatever growth, which like it could be a lot, like in California.
But a lot of people do this in like in the real estate world, like I just talked about. It's called a limited partnership, where you, like, I'm controlling the asset. I'm just using your money.
Yeah.
Like, cause I need your money to buy this 8-unit property. I don't have the money, but I'll make you a limited partner with me because I know what I'm doing. I know how to invest. I know how to renovate. I know how to build up the profits on this unit. But I don't want to hear from you. You're just an
Yeah,
investor.
I think another drawback is because California has so much involved in your almost like in your deed. Basically, they have their hands in your home. You are limited to like probably what you can do, what you can't do. So it's not like you 100% own your own house and you could do any type of you could refinance
I
whenever
think
you want.
the cash out is the main thing.
They have
but
that's the thing. What if you wanted to cash out refi?
I think it's going to be a problem.
That's gonna
Again,
be a
I don't want to
problem.
talk about it
That could be
because
a-
I don't know the 100%. I'm almost sure it's.
But
Gonna be
that's
a
also
problem.
something I feel like people don't even address. Is let's say
But you
let's
won't-
say your
but
house
you don't
blew
have
up in
any
value.
equity.
Huh? No. Let's say you have years go by, or another COVID situation happens where prices pump or rates drop,
Like
and
7
now
years from
you've
now, 5 years
gained
from now or something.
30% of equity, and you
So
need
pay
to
him
cash
back.
out.
So you could pay him back. You have no skin in the game. You have no skin.
So
in
your
the
cash
game.
out wouldn't be able to benefit you. Your cash out would be just to get you out of this.
Well, you
debt.
can get, not only can you get
Right?
out of it and possibly get a little bit of money out, depending on your value.
You'd
like
have
you
to
just
go up a
talked
lot,
about.
yeah. It'd
You
have
have
to
to
go
go
up
up
a
a
lot.
lot.
Right.
My thing is the no skin in the game. You
Yeah.
have zero skin in the game.
Yeah, you don't have any equity.
But you also didn't
That's
put
what I'm saying.
anything
You're
out
renting.
there.
You rent your own house. You're a tenant in your own house that
Oh,
you're on
you
title.
got a
of.
mortgage. You're on title.
Yeah,
There's
but
no-
you're a renter basically. California
mean-
has the house. They put everything down, and they're going to take any growth on it.
They're
It's-
not taking
not
any
taking
growth.
all
No,
of it.
when you cash out, they're going to take some of that growth.
They're going to
obviously.
take the same money
Yes.
that they put in.
Yeah, plus the principal. That's what I'm saying. It's like their house.
I think it's a fair
California's
deal.
home.
It's a fair deal. I mean,
It's
It
for
just,
people
it
who
just
can-
sounds like a legit way for California to keep buying up all their own properties or something. Like the state owns the property.
I think it's for
Think about
people that
well,
can't.
we have an
The state owns
affordability
the
issue.
property.
This is a great way for affordability, and
Yeah.
supposedly,
Yeah.
Newsom, you have a ton of money out there. Why don't you give us some more?
Because it's like what California could go use money to buy up their own properties and rent
Excuse
them
me.
out to people.
He's
like me
full
and
of
you.
cash,
but
but
instead
dish
they're
it
like,
all
we're gonna
out.
actually make you think that you're the owner, and this is the way we're gonna own your house, basically, in a way. It's just like a weird way for them to just like have their name on thousands and thousands and thousands of homes in California.
I wonder what the outlook
I don't know.
is.
It's just like it rubs me the wrong way in a weird way. I don't know.
Yeah, I wonder what the outlook on the money back. I wonder what if they said within.
They've done the numbers.
Yeah,
You know they.
Yeah, of course. That's what I'm saying.
Oh,
Within
hell
7,
yeah, they've done it
within
probably-
7 years, we will. Or within 10 years, we will.
Like they're gonna. Bill, trust me, Bill. We're gonna
that
get
$500,000 house.
Yeah.
That $500,000 house in 7 years.
Once it starts,
it's
all coming back. It's
600,000.
all
Yeah.
come
So
back.
actually, we could even. They're gonna get that's 120. That's what is that? 500 to 600,000 is 100,000. They're gonna get their 20. That's another.
What's the budget you said?
That's another 20K.
What's the budget? 300 million, right? It was 300 million.
I don't know what the budget is.
This year, I'm not sure.
around the 300 million.
Yeah, 'cause last year it was
200 and change. It's gonna help.
So
they say it's gonna help about 20.
So they run the numbers and they're like, look, we're gonna go 600 million in, and they do the forecast modeling. That's what you do. You get a bunch of CFAs to come in that are like professional license. They do the forecast modeling. They're like, the 600 million is gonna turn into 1.5 billion in X amount of years. You're gonna double basically your money, essentially.
Yeah,
especially with the growth of California.
I'm sure the problem is some people keep their homes for 30 years. Very, very rare. But mostly, the thing is, I bet you, I don't know, 75, 80% are going to be sold.
Also, what happens
the first
if you,
10 years, all this money's going to be paid back.
What happens if you die and you have to hand it down to your heirs? You know, like reverse mortgages where you have the option of like, you have to like
I'm sure
figure out how to get your ownership back?
You're going to have to pay for it.
So I'm saying, is it a complete recall? Or
no.
like they call it undo?
Well, no, you put it in a trust.
Do they even allow you to put it in a trust? Can I put my home in a trust if California basically like
I don't think you
owns the home? Like,
yeah, that's not a real. I don't know if that's a real trust at that point because California is.
That's what I'm saying. It's not a trust.
They're just a second lien holder. I feel like they're just a second lien holder.
But will they approve you to put it in a trust? Because they could say no, you can't put it in a trust, or it has to be revocable. You can't do like an irrevocable trust, right? There's no way.
Most are revocable.
Most of them are.
Right.
Most of them are revocable. I don't see why you can't put it into a trust.
I mean,
they still are going to get their money in 30
Call Gavin.
years.
Let's call him on the phone right now.
And then
as long as they get what they want, which is the appreciation, the 20%.
And most likely, when somebody dies,
yeah, like what if you die? You know,
we deal with a lot of people who have family members who passed away, and now they're selling or they're refinancing. So it's very normal. Once this person passes away that owns this home, most likely
so I got this loan. A year later, I'm dead. My kids have to get it. The house basically lost 15,000
again.
in value.
You look at like
what happened?
Again, these are like.
But it's the same conversation with.
That's possible. But you're looking at like.
Of course, death is
extreme hypothetical situations.
Death is probably more possible than a short sale. To be honest, in some situations.
I know, but death in a year is.
Well, what does a year have to do with anything? You guys should be like.
You just said a year. That was.
No, I'm saying like, what does the timeline of death happen? Because death could just happen like.
Well, because if it's 10.
The guy had high blood pressure when he got the loan, and now he croaks, and now they don't know what to do. California's like, hey.
I mean, because in 10 years you have a bunch of equity, so it doesn't matter. They're going to get paid back. I'm talking about when it's a very short period of time where you don't have equity. And especially.
Well, this is why you get a life insurance policy that pays your mortgage for you, low key. That's what it's for. Right?
All right.
Let's tie that in. This is why you get a life insurance that pays for your mortgage.
But wouldn't it be the same thing as a reverse? When you die and you have a reverse,
Except on a reverse, you have a ton of equity.
Well, of course, right.
You're always going to have equity.
Different in the sense.
Because they're only lending at like 45 LTVs.
45?
Like really, because the rates are high.
Oh, that's
so they give you a lump sum, but you still have a ton of equity. Because the reverse, they give you a lump sum, you have no mortgage.
Yeah, you have a ton of equity.
So then if you pass away, the heirs have the option of basically tapping in to maintain the house, right?
Yeah, you have a ton of equity.
Okay, so they have exit strategy.
So anyway, I think we covered this.
Interesting. Go California.
We got a good little conversation with that. That was the Dream for All, guys.
Yeah.
That was the Dream for All.
I
think it's a good program. It gets people into a home that it gets people into a payment, the quality of home and the quality of neighborhood that they would have never been able to get into unless the state literally stepped in and gave them $120,000 to buy this house. So that's what I do like about it. There are. I'm sure, yes.
If it is up to 20%, I honestly think the less you can borrow, the better. The less you can borrow. It's like,
the
less you can borrow, the better. Like, if you only need 10%, do that because then also, like, you can pay them off quicker. And if you want to have flexibility with multiple refinances,
people need money, man.
Outs,
they're trying to bring their payments down. They have an affordability issue in California.
Well, call me for a VOE-only program. Specialize in those. Yeah.
But I'm glad, by the way, last thing, I'm glad that they did a lottery because last year was absolute.
Last year was a joke. It lasted like
crazy.
7 minutes.
It was just crazy.
Yeah, I was trying to. It was a shit show.
Yeah, it was exactly.
So anyway,
Literally a shit show.
thank you guys for your opinions on the Dream for All program, and we're going to talk about probably the number one topic
in real estate.
the real estate business right now.
Drum roll.